This is Chad Toyne with your Friday, June 5 Market Minute from Trader PhD Ag Marketing. We're going to talk about the nosedive in grains, and we're going to talk about the screwworm that was found in southern Texas. I've been yapping about a meltdown for some time now, and I think I mentioned it in 2 audio calls on a single day on Wednesday. Sometimes a meltdown day happens in one single day, and usually it comes when the market is already sliding, and the meltdown day can cap off a downtrend, putting in a bottom. Beans had a whole dollar meltdown day a couple of years ago, so when we lose something like 30 cents in a day, that's really not a meltdown day. It's not as extreme as what I've seen in the past. So what we're looking at right now is a prolonged slide. First, what does it mean? And second, what should you do? What's this mean? This is what happens to a market when the funds get incredibly long, like they did heading into the Beijing summit. Then there isn't any more additional bullish news to push prices higher, and the funds were left with a market that had no more buyers. Only sellers were left, and the market started to work lower day by day. And the losses mount for all the longs. Losses mount for the long funds. They mount for all the small speculators that hold long positions. And they even put pressure on the farmers who are holding corn in storage. No bullish news day after day, and basically the funds scared themselves into a panic sell-off. How far south can these prices go? Well, that's the billion-dollar question, and unless something incredibly bullish comes along, the funds are going to have to liquidate their longs, and it seems like they have more contracts to sell. I think that they're still sitting on losing long positions. Maybe a climax sell-off day is ahead, a final meltdown day. Or maybe we have a nasty Friday and a Monday left to come and a turnaround Tuesday after a bloodbath Monday. These are just likely scenarios. All of this is subject to changes in the weather forecast, or changes in the war in the Middle East, or changes in geopolitics. But really, the most likely thing to happen is that the funds are going to need to liquidate and take their losses, and it's likely not done yet. Again, like my midday alert that I sent out before the close on Wednesday, you may have had the chance to take some hedging action if you're a more sophisticated farmer, or you could just hunker down and weather the storm, and where this size of a sell-off will be all but erased in a month or two, and sometimes less. Things can still get very wild. One of the worst things that you can do is panic sell. So second, what should you do? This market needs to bottom. The longs need to get out, and the buyers aren't going to step in until they sense that the market is near a bottom or have already had their bottom. In another way of saying, it's likely going to get a little bit worse before it gets better. But really, it's early June. I don't recall the market putting in a market low in early June and staying low all through June, let alone all of July too. There's way too much going on to expect that the weather is going to stay ace perfect, and that the Middle East isn't going to jerk crude oil back higher, or that the funds don't dust themselves off and find another reason to start accumulating contracts again. At this lower price level, end users, foreign buyers, exports are going to step in and start to buy up some cheap grain as if it's on sale. And it is. And until then, here we sit. In cotton, we've got more selling, pushing prices lower. The funds are getting squeezed and they are dumping positions. The lower crude market isn't helping matters any for cotton either. We are back to finding a bottom for a sideways trading range in cotton. And in fats and feeders, new World Screwworm was found in southern Texas. The calf was tested and it was confirmed by the USDA. Cattle futures opened lower yesterday morning and quickly came back up to break even. And the buying continued until we had a couple of feeder cattle futures contracts close limit up. And that's on the new larger limits that was set in place starting June 1. We had some early follow-through buying here this morning, but now we're near break-even today. After this kind of a news shock to the market, you have a knee-jerk reaction, and then the dust settles and things normalize. And in this case, the most likely thing to happen is for the sideways trading range to settle in, especially after we had a sagging market, and then this news takes us near limit higher yesterday. I think whatever kind of a downtrend is killed, and it's just a matter of carving out the overhead ceiling of a new trading range. Was that put in today? It's too early to tell, but it's probably close. That's it for today. I'm Chad Toyne, and this has been Trader PhD. Past performance is not indicative of future results. Futures trading involves substantial risk and is not suitable for all investors.